Hello, everyone. It's Friday, July 23rd. It's going into the last week of July here. We've had quite an eventful week in the markets and in the weather. We saw some flooding in the last 2 weeks in Germany. Veronica, therefore, is going to talk about water. But before we get into that, we're going to talk about inflation again, which we always bring up is kind of an ongoing topic. We're going to talk about growth in the Eurozone. So, Alan, you want to run through some of these numbers?
Yeah, a lot of these topics run into each other. It's basically inflation, is it or isn't it? And growth, is it or isn't it? And basically, I wanted to focus. I mean, I've certainly said in the last month or two how Europe is a good opportunity, and then I saw quite a few charts and quite a bit of information this week that makes you think twice. From the point of anemic growth targets and just how can you stimulate the Eurozone? The Eurozone is already at 0% interest rates and has been for years. And it doesn't look as if that's going to change anytime soon, certainly not in an increasing fashion. It might even go negative. Really what I wanted to focus on was a couple of things. The ECB came out with, and it was made the headlines all over the continent, was that they're being even more dovish. And basically they said that they're going to keep rates at low levels until they see inflation at more than 2% for a substantive period. Now, everyone went, well, headline, that's very interesting. That's fantastic, because the ECB are being very dovish, and they're looking at inflation over 2%. The problem is it's not going to get over 2%. That's the whole problem. Is it's not going to reach 2%. And a lot of people are saying, well, you can say what you like, ECB, but interest rates have been zero for years. And you're buying bonds at 80 billion euros worth per month in government and corporate euro bonds, and you're still having anemic growth in a pandemic where the rest of the world is opening the floodgates of cash and is seeing growth. So what's wrong with you guys? So I thought I would dig a little bit deeper, and maybe there's a couple of threads coming together there. So I just wanted to quote very quickly from I think it was Guggenheim article that I read. So the ECB was prepared to tolerate a moderate and transitory overshoot of its inflationary target, which is essentially 2%. So really, they're saying we're going to buy all your bonds, and we're going to be tart basically for as long as it takes. And actually longer than that, to ensure that there is decent growth in the Eurozone. But it's just extremely difficult to do that. And I thought I would tie in something, because I looked at an article from 2016 about Berlin and how it was competing for venture capital and fintech funds from London in the light of Brexit. And I thought, well, that's great. I read the article, refreshed the article from 2016, and then read the article. There was some articles in the press from this week, 2021, and basically it mentioned, the article in 2016 mentioned Revolut and TransferWise, who were looking to move their headquarters from London to Berlin because of Brexit, and of course that hasn't happened. And actually one of the reasons that came to light, or that came back to mind, was because of Revolut's. It wasn't an IPO, but they did a latest round of funding, which actually valued Revolut at $33 billion, which is, I think, a bit of an insane figure, but let's put that to the side for today. That's actually valued at more than 70% of the FTSE 100. So it's more than NatWest. It's more than some of the biggest banks in the UK and some of the biggest banks in Europe, frankly. So valuations are one thing, but the point is that they haven't moved to Europe. Why have they not moved to Europe? And that's a question I can't really answer today. I mean, we looked at the reasons for Berlin being a venture capital hub, that it was cheap, that it was hip, that it was open to migration. There was many different languages that you can hear: Russian, Portuguese, Spanish. All these languages, Turkish, are present in Germany and in Berlin in particular. SoundCloud, which is a Swedish startup, they did move from Sweden, but not from London. They moved from Sweden to Berlin for their headquarters. And basically, my point is that needs to be focused, and that needs to be emphasized, and that needs to be grown significantly as part of the Eurozone growth, because that's what Britain is going to do, and Britain's going to compete. So either you have a growing financial services industry in Europe, and yes, Paris is taking some jobs from London. Amsterdam has taken over the biggest bourse in Europe from London. But are these really sustainable? Is this going to add to growth in Europe? It's doubtful. It's really doubtful. Inflation is 1.9% in the Eurozone now, but that's, again, we're going to talk about that. We have talked about that. It's transitory. That people are saying that it might rise higher in the short term, but it's going to fall back to around 1.5% in 2022. So it's not sustainable over 2%. So the Eurozone, the ECB are going to have to do more. What can they do? I don't know what they can do, Chris. I don't know what they can do.
Is it tax rates, Alan? Is that what?
Well, that's what I was thinking. There's tax rates. There's a mentality, because and you can't generalize. Europe is such a disparate and diverse.
Is it also because they don't have a real centralized, centralized market for things? Like it's all really fragmented, and even financial services, as you're saying, are multiple bourses across the continent. So you don't have a centralized bourse. So it's not easy to. I'm going to list on Luxembourg Exchange and get anybody from Germany to invest into that. So it's very fragmented, and I think. I mean
that's kind of. There was an interesting interview inside one of the articles which actually mentioned that, and it said that Europe is going to be fragmented. There's no one capital and there's no one center, which in theory should be a plus, Chris. I mean, that should be good. It said basically that there's a lot of venture capital companies in Berlin, but they actually invest in other EU cities startups. For example, Estonia, which is huge. I mean, per capita, it's a huge startup location, and Sweden is a similar one. But obviously, Estonia is a tenth of the size of Sweden, something like that. So I mean,
Sweden's probably 100th the size of Germany. So I mean, these are tiny markets still. Tiny markets.
Yeah.
So it's hard.
I mean, it's just really I don't know the answer. Definitely, tax rates is one. Mm-hmm. I think there's still a lot of state centrist banks, state centrist institutions, and again, that's kind of generalizing. I think maybe south of Europe, Italy in particular. I was reading an article interviewed by an Italian guy who's and somebody was saying how terrible Italy is, and his point was, yeah, but without the EU, it would be a lot worse. There's actually been a lot of reforms in Italy because of the EU, so you can't really criticize it on that side. It's just we've just not done enough, basically. But yeah, there's a lot of inefficient state banks. Politicians and state controllers expect to be able to affect markets in the way that certainly the US, California, even London, they don't do that. But you can't actually say that about Germany. You can't say that about Sweden.
Yeah, but I at least knew some statistics. I don't know if they're the same now, but I think that I think corporates, the government owns, I think, or corporate investors, banks own, between the government and the bank, they own like 80% of the German stock market. So it's not individual investors. There's no individual investors there. It's all done through corporate pension schemes or life insurance. And now the government themselves probably buying things to help stock up the price of
right, and especially the bond side. Yeah, there's
no individual really investments. There's no really individual excitement around things like Revolut. Why would Revolut go there? Their price is not going to get anything valuable on the market, listed on the market, if they can't get the excitement from individual investors.
Yeah.
So I don't know. I mean, to me, it's one of these questions that hangs over Europe for years, like you say. Like that's
exactly it. I mean, it's a bit like Russia's always been cheap. Russia's cheap for a reason. Europe's been cheap for a while as well, and there's a reason why people look at Europe and go, well, the valuations are pretty good. Should we buy? Nah, probably not. Mm-hmm. And that's the dilemma I guess we have, because actually Europe has performed okay over the last year and a half since the big fall in March 2020.
We can look at that right here. Yeah.
But if you compare it to, I compared. I had a couple of calls last week with clients because we looked at a Eurozone fund that is only euro Eurozone and a European fund that includes the UK. And the performance of the one that includes the UK is double the performance of the Eurozone one.
Yeah.
And that was the discussion I had with the client, is that, well, maybe it's too late to get into the Euro one with the UK, because the UK's, already caught up and it's already, higher. If we think that the Eurozone is going to catch up, that's the question, then it makes sense to go into the Eurozone only fund. But it's underperformed for a reason.
Yeah, you can see it's really tailed off here since mid-June, and it's not.
I mean, to be fair,
we'll look at the markets later on, but it hasn't gone up to make new highs. It's still trading underneath its 50-day moving average here. So it's not technically set up for a great run, or the strength that you see and continually see in the S&P. We'll go over that in a minute. Do you want to talk more about inflation, Alan? Or
well, there was a couple of graphs which I really find interesting, and I'll finish after this. Just 2 minutes, because again, we talk a lot about inflation and transitory inflation or not, and there was and also about how you play the reopening of the economies, and particularly in this case in the U.S. economy. And basically, so that's probably the last graph I would look at. Chris, so if you maybe want to look at, there's one which is, so basically the biggest driver, and I pun intended, was used car prices. You can see that there. The gray column on the right end is 0.4 or 0.5% of the inflation was actually used cars. Then came new cars, and actually a little bit in car rental, but the rest was hotels and airfare, and that contributed hugely to core CPI increase.
Right.
So other prices of goods and services are not necessarily rising. It's the reopening, and I don't know, you guys.
It's the reopening and supply chain issues. It's the supply chain issues are prohibiting new cars from being produced, and the price of
the semiconductors, essentially.
Right. Semiconductors and steel prices and the shipping from China. So this is an issue with supply chains. You just can't get the cars to America or Europe.
Which is transitory, really.
It is if the supply chain opens, if people go back to work because of COVID. If not, then we have extensive high inflation or high prices on cars because there's just not that many available to buy.
Well,
so used car prices are really high because right now that's where everybody's buying, and there's supply is limited in used cars. And you can see, but new cars prices are also up. Hotels are up because they're reopening, and I was looking at hotel prices. My God, we're in Russia.
They're high. They're higher than they were in 2019.
Yeah, it's insane. I mean, little
because
places
everyone's pent up demand.
Yeah, little places on the beaches are $500 a month a day here. Just unbelievable when we could go for 150 before. So really big prices in that.
Out of the 88 basis points of the CPI last month, 64 of those was autos,
all this reopening,
airfare, and hotels.
Yeah. So that's we've seen
inflation, essentially.
Right. Yeah. And that, I think this shows the same thing then. Alan, basically, if you take out the autos and hotels, you don't have really high inflation. So it's just a matter of when that kind of transitory stuff becomes actually transitory, because if we're going to talk about the Delta variant and all this other stuff as we move along in the year and watch how it all plays out, we'll see if that actually can bring CPI back down. I think we'll show one more chart of yours. Let's go through this. I haven't looked.
I thought this was really interesting. Just not completely separate, I guess, to other things we've talked about. This was from The Economist, and it was interesting to see that there's some. If you look on the bottom right side, you'll see that some economies, and Italy we've mentioned, are going to take to 2023 to get back to 2019 levels. I thought this is the interesting. That's the base index of 100 is 2019. And you can see that China is already, exceeding. Even last year, they still managed to grow their economy. And by 2023, they'll be 125 or 123 percent of 2019. One of the reasons we still like emerging markets. If you look at a lot of those ones that are recovering faster, they're emerging markets. Even Russia is pretty decent. It's going to get back to 2019 levels this year. South Africa, Argentina are also emerging markets. Mexico is already also an emerging market. So it's not across the board, but it's interesting that some countries are going to get back very fast. And
you see, it's kind of interesting that places that are hard hit by the COVID are going to come back quick. I mean, you're looking at
Well, the reason they're being
China,
hard hit is they haven't
yeah,
shut down. That's the
right,
problem.
yeah, India, Brazil,
Yeah,
Russia,
Russia.
especially. So a lot of these big growth economies are still going to grow, and they're still going to maintain high levels of growth,
Yeah,
and they'll
yeah,
overcome their
yeah.
2019.
Our bricks are
Um,
still firing ahead. Basically.
yeah, and this is again the problem with Europe is in here with France and Italy and Germany and the EU 27,
UK at the end, even.
and the UK in there too. So
Well,
it'll be interesting. So the growth, I think that goes back to the point where there might be value in Europe, but where's the growth? And that's the question we've asked ourselves all along, Alan. It's just
right.
Where is the growth in all this? Even though the UK is so undervalued, is there anything that's going to like stimulate to make sure that this place can grow? Yeah. Or it's just going to be another year of low growth, and those things stay undervalued for a long time. Yeah. So, okay, great stuff. Actually, lots to talk about always with inflation. Veronica, you wanted to talk about water, yeah?
Yes, my talk is about water today. Especially, I got a little bit inspired by billionaires' space race that they've been criticized widely in Financial Times and all financial magazines and journals. So, like, why they're looking into space? Well, we have so many problems on our planet. We just look into shortages of water, look into desalination. I'll run some statistics right now. Like by 2025, 2/3 of the world's population may face water shortages. Now more than 2 billion people don't have access to clean drinking water. 2 billion of the world population. So water is in short supply, though we see lots of water floods, flooding in Europe. But even with flooding in Europe, it's also water-related issues that a lot of big listed companies face losses. Like, for example, in 2019, the 783 big listed companies had faced a total of 40 billion water-related losses. But also now portfolio managers worldwide are realizing that physical, reputational, and regulatory water risk could hurt their investments. So especially in industries like food, mining, textiles, and utilities. So water affects a lot of areas of investments, and we should pay close attention what's going on with water. But today in particular, I want to talk about direct investment in water, and talk about water as a commodity. And like any other commodity, high in demand, you should keep an eye on it for investment purposes as we get closer and closer to peak water. And on this map, you see around the world that specific shortages that we expect by 2040. And of course, it's United States and just in general, South and North America and areas in Asia. China is in a really terrible stress situation. Even some parts in Russia and South Africa, of course, Australia. And at current rates of consumption, the demand of water worldwide will be 40% greater than its supply by 2030. So the market price of water, of course, right now doesn't reflect the environmental and social costs of using it. And if we look at Fortune 500 companies, if they paid the true cost of water, rather than current prices, then their profit margins would shrink by a 10th. Margins for food, drink, tobacco firms would fall by 3/4. So this might come in the future. And as investors, let me switch the slide. As investors, if we look at the investment in water, you can see that for the last 15 years, water, in terms of risk return, water was a pretty good investment. It higher than anything on this list. And also, this is like S&P 500, S&P 50 countries that invest in water. Let me go over specific ETFs and maybe certain companies that invest in water currently. And if you want to be a long-term investor in water, this is the ETFs and companies you want to look at. So number one is Invesco S&P Global Water Index, and it mostly invests in companies that are in the areas invest in infrastructure and equipment, utilities, instruments and material companies, and more than half of them are in the United States. It's a broad exchange traded fund. If you want to go more specific into water investment, then we can look at PHO. And PHO, I was going to mention most of these ETFs made 25% this year. So you can see it's already in high demand, not only for retail investors, but for ESG funds as well. And this particular index is focused on tracking companies that actually create products that conserve and purify water for homes, businesses, and industries. And it holds 36 small and mid-cap companies across a range of industries. And more than 97% of those holdings are located in the US. Another ETF is PIO, also had a good run. PIO is much like the water resources ETF. It has a focus more on a large cap growth companies, while 51% of the funds holdings are based in the United States. The other 49% is spread out among UK, Switzerland, France, and other countries. So the other interesting investment is trade futures. You can actually trade futures on water. And that's NASDAQ Dallas California Water Index. And specifically, it's a water traded from California's 1.1 billion water market via the NASDAQ Dallas Water Index. So let me look in this index as well. So this is a wide range of different indices and companies you can go into. And besides ETFs, you can also invest, as I mentioned, into futures in water. As an investor, you can also go directly into specific companies, like, for example, AWK Water Technologies, the ticker symbol AQUA. And it's a water treatment company, so it's a good stock to tap into. Though good water stocks, there are a few good water stocks, but there are not enough on the markets. That's why also in portfolio management companies looking for them as well. We can also mention the AWK, American Water Works, and Ecolab. AWK is more volatile, and Danaher, DHR. This is individual stocks that invest in water-related industries.
A lot of good performance in these stocks. We should put together a little list and watch these more carefully for buying opportunities, because yeah, this is kind of an interesting thing for the next few years. It's going to be a very hot topic, very, very hot topic.
And they overperformed the market already.
Mm-hmm.
The future looks really good for the
We've been aware of Pictet's water fund for quite a long time. I've always been a bit puzzled by it because it seems to be too diversified, or it just focuses on a lot of strange things. For example, it focuses on ceramic sanitary ware, for example, which I've always found bizarre for a water fund. I know it's related to water, but I've never understood why or how. But there are similar some of the names that you just mentioned, Veronica, that they do invest in that, and they invest in water utility companies in various countries, companies that make reverse osmosis machines, desalination machines. These are the kind of interesting things as well, I think. So, and it's a fund that's done well, actually. It's performed well over the last 10 years.
It's interesting. Some of them, invest in companies like, Coca-Cola, Pepsi-Cola, because those companies invest in water plants in emerging markets. Like, for example, Coca-Cola invests in India water plant, but they were forced to close it down because of the drought.
Yeah, what I'm showing is the Pictet Water Fund, basically. And the problem is it tracks the world so closely, so it's not really a great fund for this. And as Veronica was talking about, probably it includes
like Geberit.
Well, it includes Danaher, which Veronica brought up.
Geberit is the fourth biggest thing.
Right, but then it includes
sanitary ware.
Yeah, IDEX Corporation, which is not really, just some strange names. Republic Services, Waste Management, a lot of waste management. Thermo Fisher Scientific, which is basically, maker of scientific equipment. So lots of stranger things in here. I was actually expecting to see Coca-Cola and Pepsi in here. Maybe Nestle is the big play in water because they own so much rights to headwaters in the United States. There's been a lot of
it's a lot of negative publicity about that.
Yeah, there's going to be a lot of political issues are going to come up about this. Like, how did we end up selling, headwaters in the United States?
How do you buy it? First of all, who do you buy it
Nestle. From? How did Nestle get the headwater rights to the rivers that flow in California? So this is kind of going to be a big issue coming up, and I think there's going to be some reevaluation.
They don't own the headwaters in Italy, I'll tell you that.
So yeah, this is quite interesting. This hasn't been, like you said, though, this hasn't been one of the greatest funds to use, and it's been often better to pick out specific stocks or just an ETF.
I just made the point that it's not performed badly.
It hasn't performed badly. It has not.
It's done okay. If you wanted to play the water area strategy, that would have been not a bad fund to put it in.
Yeah.
But there probably are the funds to put it in because they are more specific to water companies, even like CGW, the Global Water Index. It's S&P Global Water Index. So it's more focused on the companies that are.
Yeah. Again, a lot of stuff does trade much like the S&P 500. So it's
but still the outperformance.
Yeah. Okay, so I'm going to go in and talk about something I was just researching while you guys were talking about water and inflation. And really, I want to read off some statistics that have scared the market this week, and then the market had a big rebound. We can see that in the S&P 500. I'll just bring this up really quick. We're again making new all-time highs after we had this big collapse last Friday and then Monday of this week. The Delta variant. Let's talk back a bit about COVID, and I'm just going to bring this up and show here how important this Delta variant is. And this is where the Delta variant kind of is now in large S. So you have places like Australia, parts of China, India, of course, Russia, where we were last week. Lots of new cases of the Delta variant, and that's really, I think, it's not just the fact that there's the Delta variant in these places, but it's the effect it's having on the political climate and the economy. And so I want to read off, if we look at how is Australia doing now that they're quite heavily infected with the Delta variant of the COVID? So Australia's flash manufacturing PMI showed a 1.8 decline in July to 56.8, which is above 50, so it's still positive. However, their service index, services PMI, we talked about this last week, how this is important. It fell hard and back into contraction territory, crashing 12.6 points to a 14-month low of 44.2. 44.2 is now below the 50 level, and the economy is now, the service index is now contracting again. This is scaring the market. If Delta variant does travel west from here, moving, it's heavily affected in the east right now in Asian markets, but if it travels west, the markets are getting prepared for another, a downturn in travel, a downturn in service activity. You can look at UK. UK does stand out here. It's been difficult for the UK to open again this summer. The manufacturing PMI and flash services both hit 4-month lows of 60 and 63.9. Very high numbers still for PMIs, but respondents in both surveys widely reported staff and raw materials shortages, which were hampering growth. And there was also widespread disruptions amid an increase in coronavirus infections. Against this backdrop, the survey saw a 9-month low in forward optimism. If we look at how people are responding to this, business owners and business forecasters are saying, look, things aren't going to get worse probably before they get better. And the talk of an opening up again, it may be that people not only are traveling less, but shortages may remain, which gives us this strange, complex situation where inflation levels may remain high for quite a while because of the shortages. And at the same time, we have low growth or slower growth. So it becomes a really dangerous economic problem for central banks to combat with just lowering interest rates. I mean, there's just no way to stimulate the economy if people cannot get back to work and cannot open up supply chains. And at the same time, there's no demand for them to go out and spend money because they're locked up at home or not feeling safe. Now, let's look at Eastern China. Again, this is one of the places where it was affected. So Eastern China has been locked down since Thursday evening again. And China has a strange problem. They went into the COVID crisis first and came out of the COVID crisis kind of first, right? But because of that, they haven't taken seriously really into vaccinating their population. And so they started now they've started mass vaccinations, and they're doing tests on, they started a mass testing of 9.3 million population of 9.3 million people living in the Nanjing Republic. A lot of people, and they don't have a lot of these people actually vaccinated, and they don't even have them tested. So these new numbers are coming out, and they've suspended in the meantime their subway line that's linked the airport to the train station. They sealed off some residential compounds. So these are kind of really aggressive tactics in terms of lockdown that China is again experiencing. So we have to really watch how, first of all, the Delta variant moves west and the effect on the PMIs in those countries where the Delta variant is spreading.
What's interesting to compare those two countries and those two situations, they're actually both very worrying and have similar, I suppose, outcomes economically, but they're actually extremely different. Because the UK opened up because it's got most people vaccinated, right. Certainly more than 50%. So I guess that's most people vaccinated, at least once. I think there's something like 52% have been double vaccinated. I think it's close to 70% from one vaccination. But anyway, there's quite a lot of young people still not being vaccinated, and obviously children under 18, most of them have not been vaccinated. But most of the vulnerable people are. So what you're seeing is the Delta variant has caused huge amount of contraction of diagnosis of COVID amongst the UK population. But what is not translated yet, at least, and we hope not, it's not translated into high levels of hospital figures, and it's not translated into then high levels of death. The staff shortages are people being told to isolate because they've come into contact with people who have been diagnosed with COVID, a Delta variant. And because masks are not being worn, because social distancing rules have been relaxed, because everything's opened up again, that is a huge number of people, because before it was unlikely because shops were closed or swimming pools.
It was under at least partial lockdown.
It was under partial lockdown, right. And restaurants were only open outside and all this kind of stuff.
Right.
It's common in many, many different countries. But the UK basically said, okay, we're all vaccinated, so we don't care. And after 2 weeks, they went, small problem, because when you do get people that are getting the illness, asymptomatic or not, and getting tested for it, then they're being, anyone who's come in contact with them in the last, I don't know, 1 week or whatever, is getting, they call it, they've even got a name in the UK, it's called the pingdemic. Because people on their mobile phones have been pinged to self-isolate. And this is causing huge shortages in the logistics sector, health. Like there's nurses, doctors, dentists, they've all like, sorry guys, we're not coming into work today. We've got to stay home. And this is a huge crisis because of that. And so this is a huge gamble, and it's a huge experiment in the UK. The rest of the world will get to. Only China is a different situation because they haven't had the vaccination, and they've actually been very good at, test and trace, controlling their borders, making sure that people who are coming into China, into certain areas, were quarantined, isolation, all of these kind of things, right? Strict testing, all of these things. They were trying to keep it under control that way, rather than the vaccination, while the vaccination's caught up, and they haven't got to that stage yet. And this is
right. And I think the scare for Eastern, and especially in China and some of the other places, is if you don't have a largely vaccinated population, if you get the Delta variant, it's more severe, and it can lead to more hospitalizations and deaths, and that's what's kind of scary there. Whereas
if you look at this,
West, it's not a fear of dying. It's not a fear of this. It's just a fear of it's going to be contagious, and we don't want to give it to other people. So we're trying to manage lockdown.
I was actually looking, one last word for me on this. I looked at the numbers in Sydney, Australia, for the city of Sydney, and yesterday they had 100 cases, and it was like a disaster. Because they've never had 100 cases in Sydney in one day before. Never. Because they've been so isolated and controlled with their test, their quarantining, their isolation. And now they're saying, well, it's threatening to run out of control.
Yeah, so I just wanted to tie that really quick. The COVID thing is still a big story. We can't just ignore it because it does have implications for both the shortages and return to work. There's a great, I can't find it now, but there's a great graphic. I think The Economist did a poll, or Bloomberg did a poll, and said, would you go back to work? And, the whole idea of how many people are going to go back to work. And a lot of these companies are saying a three-day work week would be good, because that's what our employees want. They want 2 weekdays at home, and they want a 3-day work week. And I think the numbers are staggering, like 60% or 70% of the workforce.
And a 3-day work week in the office, you mean, Chris?
Right, in the office. In other words, 3 days you have to be in the office, but you can take 2 days and be at home. So your Mondays and Fridays are at home, and you go in Tuesdays, Wednesdays, and Thursdays, or something like that. So you have basically a 4-day period where you're home.
Well, you can actually stagger it to mean that there's less people in the office at the same time.
Right. And it's 60 or 70% of the workforce believes that's the way that they should work. And so there's going to be a massive change in what we see in terms of productivity, in terms of travel, in terms of occupancy in the offices. And this stuff is really new. It's really, really new. And I think I'd like to cover this a little bit next time in the fitness.
I'm still skeptical of that. I think it'll go back to what we had before, but it might take a while.
I think at least in the United States, there's this feeling that the commute is so difficult in places like Los Angeles and San Francisco and these big cities, New York, that it really doesn't make sense to have to go to the office all the time, number one. And number two, a lot of these people that lived in the city have bought houses other places and are thinking, I'm not going to go move back. I made the decision to move out. And so there's a reluctance.
Change my employer rather than change my location.
Right. So they're calling it the big quit. And there's we'll talk about this next time. It's called the big quit, and it's talking about how to get people back to work, even not back to the office, but just back to work after they quit their jobs and move to the sticks, right? I do want to bring up, how the S&P has been performing. We did see it make new highs again. It's on, incredible run up after that 2-day sell off. Are we going to get bullish here? is this a bullish period? The answer still remains no. I did publish just our August seasonality on our website. It's a great read. You should read about how bad August actually is, especially in post-election years. You'll see a lot
Especially
of
in
negative
Russia.
Every year it'll.
Yeah, exactly. And Russia's been one of the reasons that August is a bad time for Russia. So, you got 1 week of really positive news around the expiration, but both beginning and the end of August are weak. So we'll talk about that more next week. One of the things we did see, and we've been talking about this, is some extremely oversold situations in the market, and we saw this level where NIMO, which is the amount of stocks going up versus going down, we saw this breadth weakness in the market, and which reached levels that we hadn't seen it since the crisis back in
the COVID crisis.
So the S&P itself doesn't show you this in its chart. It shows you, there's a lot of stocks that fell. It touched its 50-day moving average intraday and then shot back up since that. But if you look at the Russell, which we like to look at in this IWM, we talked about how this is going to likely.
That's had a few huge bad days in the last week.
Yeah, huge bad. It's nowhere near making a new all-time high. It's actually come off of that and failing again. So we talked about how there's this line here. I'll draw the line itself right now, just to be kind of clear that along this line here, it seemed to hold up again, but at some time it's likely to break down below this, and that's when the market can really fall apart. The market, though, is on a buy signal now for this the Russell 2000 in terms of its internal indicators. We might get a little bit of a continued push next week to higher levels. We'll see, but this is not the greatest time to be invested, and anything on the upside here you can use as a selling time, because August is going to be a weak month if it's anything like its historical norms. So we'll go in and talk about that on Wednesday in Russian a little bit, and then we'll talk about that again on Friday next week. Thank you for joining us, and have a good weekend.